Hello everyone, Assalamualaikum warahmatullahi wabarakatuh. My name is Salma Sofia Priyanti from class of 1H number 21. Today I will presentation about inventory in accounting. So let's get started. So the first is, what is inventory? Inventory is a term for the goods available for sale and raw materials used to produce goods available for sale. Inventory represents one of the most important assets of a business because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. The benefit of inventory. Possessing a high amount of inventory for a long time is usually not advantageous for a business because of storage costs, spoilage costs, and the threat of obsolescence. However, possessing too little inventory also has its disadvantage, like the business runs the risk of market share erosion and losing profit from potential sales. Inventory management forecasts and strategies such as a just-in-time inventory system or with backflush costing can help minimize inventory costs because goods are credited or received only when needed. The next is the example of inventory. Consider a fashion retailer such as H&M, which operates on a seasonal schedule. Because of the fast fashion nature turnover, H&M, like other fashion retailers, is under pressure to sell inventory rapidly. H&M's merchandise is an example of inventory in the finished product stage. On the other hand, the fabric and other production materials are considered a raw material from of inventory. So the recording method of inventory, the first is first out or FIFO method. The cost of goods sold is based on the cost of the earliest purchased material, while the carrying cost of remaining inventory is based on the cost of the latest purchased material. The second is last in first out or LIFO method. The cost of goods sold is valued using the cost of the latest purchased materials, while the value of the remaining inventory is based on the earliest purchased material. And the third is the weighted average method. Requires valuing both inventory and the cost of goods sold based on the average cost of all material bought during the period. The next is types of inventory. Is divided into three parts. The first is raw material. The definition of raw material is unprocessed material used to produce a good. The example is aluminum and steel for the manufacture of cars, flour for the bakery's production of bread, and crude oil held by refineries. The second is work in progress. The definition is the partially finished goods waiting for completion and resale. Work in progress inventory is otherwise known as inventory on the production floor. The example is a half-assembled airliner or a partially completed yacht will be work in process. And the last is finished goods. The definition is products that have completed production and are ready for sale. Retailers typically refer to this inventory as merchandise. The example is common example of merchandise include electronic, clothes, and cars held by retailers. This is the inventory journal entries example. The first is inventory purchase journal entry. Okay, the example is say you purchase 1,000 worth of inventory on credit, debit your inventory account $1,000. To increase it, Then credit your account payable account to show that you owe $1,000. Okay, we put the inventory in debit, $1,000, and account payable in credit for $1,000 too. The second is manufacturing a product. The first is raw materials. Now let's say you bought $500 in raw materials on credit to create your product. Debit your raw materials inventory account to show an increase in inventory, and credit your accounts payable account $500. We put raw material inventory for the debit for 500 and account payable in credit for 500 too. After the raw material, we go to work in process method to show that raw materials have moved to the work in process phase. Debit your work in process inventory count to increase it, and decrease your raw materials inventory count with a credit. So we put work in process inventory in debit for 500, and we put raw material inventory in credit for 500. And the next is finished good. Finally, when you finish the product using the raw material, you need to make another journal entry. Debit your finished goods inventory account and credit your work in process inventory account. Then we put finished goods inventory in debit for 500, and we put work in process inventory in credit for 500. After all the process, we finally in item ready to be sold. When an item is ready to be sold, transfer it from finished good inventory to cost of goods sold to shift it from inventory to expenses. Debit your cost of goods sold count in credit your finished goods inventory count to show the transfer. We put cost of goods sold in debit for $500 and finished goods inventory in credit for 500. The last is cash shell. Say a customer pays for a product in cash. Debit your cash count to record the increase in cash. To account for how much the item costs you to make, debit your cost of goods sold account. You also need to credit your revenue account to show an increase from the sale, and credit your inventory account to reduce it. So we put cash in debit for $500, cost of goods sold in debit for $300, and we put revenue and inventory in credit. For revenue, we put 500, and for inventory, we put 300. I think that's all for my presentation today. Thank you for watching, and wassalamualaikum warahmatullahi wabarakatuh. Bye.